bags. Hey gang, today I have some good news and even better news for those who've been watching the previous videos on how to chase this bag. In this video, we're going to introduce how merchandising inventory affects a company and how to properly record the transactions as they take place. But first, as we already know, businesses are chasing the bags just like you and I. They do so by earning revenues. Remember, gang, there's two ways in which we can actually earn revenues: by either providing a service or selling a product. In this particular lecture, we're going to discuss the selling the product aspect of a company, thus a merchandising company. And so with that being said, we have three types of companies that you can engage in business. You can either have a service company, you could have a manufacturing company, or you could have a merchandising company. So let's quickly discuss these three. With a service company, generally, as it said in the title, this company generates revenue by providing services. Examples of those would be tattoo shops, doctors, lawyers, accountants. They provide services in order to increase their revenue stream. In contrast to the other two, manufacturing and merchandising companies, the manufacturing company manufactures a good that they expect to sell to the end users. So they take raw materials and add some people hours to it to create this new product or inventory that is being sold to generate their revenues. Now, we're focusing on, in this particular lecture, merchandising companies. So think of these guys as the merchants. They're the middlemen. They're the plug. So basically what a merchandising company does is purchases the already established inventory from a manufacturing company and then sells it to the end consumer. So merchandising companies generate their revenues strictly by selling inventory. And inventory is one of those particular important assets because it helps the company directly receive cash. And so we're going to discuss how to properly address merchandising inventory. But before we do that, there are two particular systems in how you can choose in order to account for your inventory that's being purchased or sold. Remember, gang, when we are merchants, we are purchasing inventory as well as we're selling. Very critical that you understand that there are two distinct aspects as a merchandiser. So, what are the two systems that we can go by accounting for purchasing and selling our inventory? The first one is called the perpetual system. What's the perpetual system? Well, based on this system, the perpetual system encourages you to consistently adjust your inventory after every purchase and every sale, thus making your books as accurate as possible with the proper adjustments of your inventory balance. So consider going to Walmart or Target or one of those other major retail stores. The minute that you actually go self-checkout, right, and you scan the optical barcode and it's beep beep, right? Well, what happens is that particular system constantly adjusts the inventory. Thus, Walmart will be practicing the perpetual system. Now, in contrast to the perpetual system, there's also the periodic system. And at this point of the game, I know you all are familiar with the keywords. And periodic system encourages you to periodically adjust your inventory. So I want you to think about that from the aspect of those mom and pop, very small stores that may sell candy and certain home goods, right? We usually call those corner stores. Well, those particular companies, because they're so small, they used to practice the periodic inventory system, meaning that at the end of the week or possibly the month, they would go back and physically count the inventory, then adjust the books. So from this aspect, you already know which one you would want to have to help run your business, right? Obviously, the perpetual, because it keeps an updated version of the correct balances of inventory. So with that being said, I like to give a beautiful illustration of the differences between a merchandising company and a service company in regards to the financial statement. Okay, gang, so here we have a beautiful example of both a service company's income statement versus a merchandising company's income statement. And remember, the key primary difference between the two is that merchandising companies act as merchants. They're the plugs, right? So they generate their revenues, sales revenue, by selling goods. So inventory is a very critical aspect for a merchandising company. And so with that being said, I want to focus in on a difference in how the income statement appears. So if we take a look at the service company, these guys are only providing services. And so for their particular income statement, their expenses are reported as operating expenses in total, right? And so we have some salaries, rent, utilities, and a delivery expense. Give us a total operating expense, and we have produced our net income for the period. In contrast to the merchandising company, inventory is key. And so one thing we have to remember about inventory is that when it's purchased, initially it's an asset, but the moment that it's sold, an expense arises, the cost of selling inventory. And what do we call that? Cost of goods sold. And we already know the game. We're not gonna sell a product at cost. We always sell it at a price above so that we can generate a profit. And so that's what viewers want to focus on from a merchandising company. How much profit is being generated for the period, i.e. gross profit. And so that's the first thing you want to report as a merchandising company. And so we've delivered was sales revenue minus cost of goods sold. And that's going to give us the gross profit for the period of $13K. After we've calculated and reported our gross profit, we then could report the other additional operating expenses that incurred for the period. And once we get a total op, we subtract that from our gross profit, and that will leave us with net income. So the major difference between the two, gang, is that from a merchandising company's perspective, they're going to always have cost of goods sold reported on the income statement so that they can calculate gross profit. Now let's take a look at the differences that arise between a service company and a merchandising company on the balance sheet. And so this is a partial example of a balance sheet because the only difference lies in the asset columns. So, as we already said, inventory is key for a merchandising company. If you are a service company, there's no inventory to be sold because you are generating service revenue by providing services. Think of doctors, think of lawyers, tattoo parlors, those type of places, right? Service companies. In contrast, the merchandising companies will always have inventory on the books. And since inventory is an asset, that's the major difference game between the two. Look at the service company. No inventory in sight. But when you focus on the merchandising company, we can see that we have an inventory amount that's reported for $6,000. Inventory is always considered a current asset. Why? Because hopefully we expect on turning that into cash as soon as possible, right, gang? And therefore, most inventories, depending on the company, for most companies, should I say, are being converted into cash less than 12 months, which makes them a current asset. Very highly liquid. And so with that being said, that wraps up the differences between a merchandising company and a service company when it comes terms to financial reporting. So as always, gang, it's been a pleasure here to help you chase the bags. And if that light bulb is clicking upstairs, don't forget to like, subscribe, and share the channel with your friends so that they can also chase the bag as well. I look forward to seeing you guys soon. Bags!